Hey, it's time for a quick update on the potential US government shutdown and what it could mean for your investments. So here's what's happening right now. Congress still hasn't agreed on a budget past September 30th, 2025. The House passed a short-term funding bill, but the Senate shot it down. Disagreements over healthcare Medicaid. Now the White House is telling agencies to prep for something called reduction in force plans. That means permanent layoffs in some areas, which is a lot more severe than the usual furloughs we see during shutdowns. But don't panic. Essential services like the military Social Security will keep running. It's the non-essential stuff that could stop. And a big deal here is that federal economic data could be delayed. Jobs, inflation, retail sales. That means the Federal Reserve and all of us will have a harder time figuring out what's really happening in the economy. Let's talk about what this means for the stock market. First, expect volatility. Investors hate uncertainty, and missing data just adds to the confusion. Some sectors could feel real pain, especially government contractors, defense companies, travel, biotech, energy. A long shutdown can drag down economic growth too. For context, the 2018-19 shutdown cost the economy about $11 billion, with $3 billion lost for good. Bonds might get weird. Sometimes investors rush to treasuries for safety, but at the same time, risk premiums can push yields up. But here's a silver lining. Historically, the S&P 500 usually recovers pretty quickly after a shutdown ends. So what should you do as an investor? Here are a few tips. 1. Stay diversified and don't panic sell. If you're investing for the long term, it's better to ride out the volatility than try to time the market. 2. Keep some cash on hand. Some sectors might underperform, so having liquidity lets you buy good stocks if prices drop too much. 3. Focus on resilient sectors. Consumer staples, utilities, healthcare, dividend-paying ETFs, companies with strong cash flow. 4. Be careful with stocks that rely on government contracts. Payments could be delayed, so expect some bumps in the short term. 5. Watch the bond market. Treasury volatility can affect mortgage rates and borrowing costs. Short-term treasuries, money market funds. 6. Pay attention to the Fed.